Now, here is Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. Coming up, we're weeks ahead of a big meeting between China's Xi Jinping and US President Donald Trump, weighing in on China's future with Bhanu Baweja, Deputy Head of Global Strategy at UBS, and Richard McGregor, Senior Fellow for the East Asia at the Lowy Institution. Alibaba smashes Singles Day again in 2018. Your Money Chief Business Reporter Leo Shanahan touches base with Alibaba Australia and New Zealand Managing Director Maggie Zhou in Shanghai. And talking fintech and venture capital with co-founder of Square Peg Capital, Paul Bassett. Well, yet another twist in the battle for hospital health business, Healthscope, with the return of Canadian's Brookfield, which has lobbed in a bid valued at around $2.585 a share, made up of part cash and part scheme of arrangement. Now, that compares with the bid that the Healthscope board knocked back the other day of $2.36 a share, one from private equity outfit Ben Gray's BGH Capital and Aussie Super, which are locked together in that exclusive bid. Now, not only had Healthscope chair Paula Dwyer refused the bid, she'd also refused BGH access to the data room for due diligence at the rather controversial AGM the other day when the board got a first strike. And there was a fair amount of pressure from the market and shareholders to at least grant the BGH consortium a kick of the tyres. Well, now we know why. Instead, Brookfield has been granted access to do that due diligence. The Brookfield bid has been designed very carefully to get around the BGH Aussie Super bid and its exclusivity agreement. Indeed, it's no doubt partly a pitch to CEO Ian Silk and Chief Investment Officer Mark Delaney at Aussie Super to reconsider. Look at the dates for a start. Brookfield's scheme of arrangement would take effect from the start of April. That's just after the exclusivity deal expires in March. The Brookfield deal would also allow Aussie Super to retain a shareholding going forward in the new Healthscope as an unlisted company. So where does the 10% shareholder in Healthscope, the other one, Ashok Jacob at Elliston Capital, sit now? Well, at the Healthscope AGM, he was definitely a seller to the BGH consortium. But this Canadian offer looks quite a lot higher, at least on the surface, doesn't it? The other impact the Brookfield bid has had is that it allows Healthscope CEO Gordon Ballantyne and his team to carry on with the strategy of extracting value from part of the hospital portfolio. Well, BGH would likely have been more aggressive there and no doubt would have argued that it would have left Healthscope business with flexibility around development, even if it did. On the face of it, though, it sure looks like Paula Dwyer and Gordon Ballantyne see Brookfield as something of a white knight, one that might support a good part of their vision for Healthscope. We're all waiting to see what BGH does next. Ben Gray clearly thinks the business can be run better, and he's pretty familiar with the assets from when he was at TPG Australia. But BGH must be feeling a little unloved this morning. They also got a knockback on their other big bid for Navitas. In a statement to the ASX, Navitas made it really clear that it was pretty unhappy about Aussie Super's exclusive agreement with Navitas founder Rod Jones to vote against any competing proposal to the BGH one. Well, it'd be good to know whether this is all happening because these boards are uncomfortable with Aussie Super on the register having a conflict which basically stops them from accepting a better offer for shareholders, or is it just that boards believe the price is too low? Well, a lot going on in the region over the next few days, with Asia-Pacific leaders heading first to Singapore, and then many go on to the APEC summit in PNG. At both, trade and resolving regional conflicts will be top of the list. Rather controversially, US President Donald Trump will not be turning up, sending instead his Vice President Mike Pence to the Singapore summit. China is expected to rally support for a pact which is tipped to be the free trade deal encompassing more than a third of the world's GDP. The pact includes 16 countries, including China, Japan, India, South Korea, but not the United States. And all the time we've got the trade war between China and the US simmering away, undermining global markets. And we're also just weeks away from the big G20 meeting between Trump and Chinese President Xi Jinping in Buenos Aires. Well, today, the UBS Australasia Conference 2018 kicked off in Sydney, and I caught up with two of the most interesting China watchers on the sidelines there, Bhanu Baweja, UBS's Deputy Head Global Macro Strategist, and Richard McGregor, Senior Fellow for East Asia at the Lowy Institute. Bhanu Baweja and Richard McGregor, thank you very much for joining me. Now, we've just had this record singles day in China, Bhanu. I just wondered, how do you see the consumption story playing out and indeed the economy?
The consumption story is a great theme medium term. I think we have to be quite careful in understanding, extricating the cyclical from the structural. So I think the mistake that the market made a little while back was extrapolating peak cycle earnings into the infinite future. And that's why, in fact, this year, if you look at the Chinese market, the consumption story has come under significant stress. Consumer discretionary, consumer staples have come under significant stress because a lot of this was based on credit. So consumer has not been levered till about 3 years back, which is when mortgage credit significantly ramped up. That led to household spending, that led to the peripheral spending across household appliances as well, and that led to consumer doing extremely well. That's what the market began to extrapolate, and that's coming off. I do think that the Chinese consumer is going to be a strong medium-term story, but the kind of multiples the market is trading it at right now, I think, are much too high. So we see further downside out there in the near term, I'm afraid.
And what do you think this stimulus that everyone's talking about at the moment that Xi Jinping might deploy will do to the economy?
Let's put it in context. China has had three stimuli, if you want to call them, from 2009, and they have fathered the global cycle since then. Each of them has been a massive credit increase and has gone to the housing market. The last one went to the Chinese consumer and the housing market. Both their willingness and their ability to stimulate from here is a little more limited. Willingness because they understand that debt's a problem. Ability because now China doesn't run a current account surplus of 10% of GDP. In fact, it runs a very small deficit. And now, just like every other economy does, China has to make a choice between external stability and growth for the first time in 25 years, I might add. So China is not going to give you the same magnitude of stimulus. That's the first point. The second point is that the nature of stimulus is going to be different, and this matters a lot because if it is a housing market-driven stimulus, it has a much higher multiplier effect, not just within upstream and downstream sectors in China, but also for peripheral economies like Australia, like South Africa, Indonesia, and so on, so economies that depend on the China story. If the stimulus is going to be in infrastructure, which is much more likely this time, well, this is going to go into stuff like water conservation, environmental protection, waste management, which doesn't do as much for the Australian economy or for the South African economy as it does for the Chinese economy. So it's going to be much smaller and much more domestic.
And Richard, how do you think the Chinese stimulus and indeed the trade tensions are going to play out on the relationship between the two superpowers, China and the US?
Well, I think the if everybody gets their slide rules out and they look at the tariffs, and there's not much impact. But the tariffs are just one aspect of a much larger political war, if you like. The US is interested in what they call decoupling. In other words, cutting the economic ties between the US and China as much as they can, or at least in a targeted way. Now, there are many people who say that decoupling is not possible, but the US is going to try. And they are focused on a certain number of technologies, capabilities and skills now housed inside the Chinese economy as part of a global supply chain. They want to tax them and force them out, maybe to Malaysia, maybe to Taiwan. If Donald Trump has his way, maybe back to America. But that's the big theme to look at about whether the US can do it, number one. And number two, what happens to US allies in the region, particularly South Korea, Taiwan, Japan, whose economies are integrated into this China supply chain. Can America force them out? If America says you choose between us and China, maybe they have to choose China. So that's the sort of big game unfolding in front of us.
Yeah, well, Xi Jinping is actually going to PNG for the APEC meeting. Do you see anything being resolved on the trade front by then, or indeed by the G20 meeting in South America, or will it be a standoff?
There may be something at G20, but I doubt the Chinese would place much store in that, because the moment Trump makes a deal, 10 minutes later, 10 days later, he throws it out if he comes under criticism. But the great game is still underway, and APEC will be a good example of that. Xi Jinping will spend 4 days in Papua New Guinea. That's quite amazing. So he's not just going to APEC, he's not just cultivating Papua New Guinea, he's going to hold a summit for the 14 out of the Pacific nations which recognise China. About 5 still recognise Taiwan. So China is putting enormous political and economic, small relatively speaking, big for the Pacific, investment into the region. Papua New Guinea is particularly important, one of the last great untapped sources of resources in the region, number one. Number two, potentially an important security partner for China as well, maybe for a listening post to look north.
Well, yeah, there's a big ding-dong going on, isn't there? Because our Prime Minister has now put his paws back on what he sees as our patch.
Well, that's right. I wish we wouldn't talk about it as our backyard, but we seem to do that. But certainly it's true. China has been a wake-up call for Australia and the Pacific. So we've announced a whole range of initiatives, including, I might say, an infrastructure bank. Both the Labor Party opposition and the coalition government support that. But I wonder if we're late to the game, because we're just coming in with an infrastructure bank at a time when these Pacific nations really don't have any capacity to borrow. So we may end up giving budget supports to these Pacific countries, which in turn really helps them pay back their loans to China. Now, that's not the kind of stability we want, but we've got a lot of catching up to do and a lot of refining of our policy and investment to do as well.
Bhanu, more broadly, do we see China moving into a slowdown, and is there a fragility there? Because we always think of China being very economically very much of a superpower and geopolitically very much of a superpower.
China has been slowing down for a long time now. I mean, just as recently as 2011, it wasn't that long back, China was growing at 10%, and it is now growing at about 6.5. I think it is almost certain that they will slow down from here, because the levers that led Chinese economy to become as strong as it was, which were primarily exports and construction, are both at a very mature stage. Construction has been about 12% of Chinese GDPs, and I don't think it will continue at that pace. So China will slow down. The question is whether that slowdown is going to mean China enters a balance sheet crisis or some sort of crisis that many people have been waiting for. I don't think that's very likely.
Yeah, so the fragility that the people talk about when the Chinese are doing their expansion with things like BRI.
But BRI is a small part of their overall spend. It's a political project, and oftentimes these political projects have not been very useful to the state or to its citizenry. But that's a slightly separate point from saying that China is going to enter a crisis. So if I could oversimplify things, I don't think China has a balance sheet problem. But I do think China has an income statement problem, in that Chinese growth is going to weaken from here, perhaps at a slightly faster pace, because I think both Chinese willingness and ability to continue to stimulate the economy, particularly in housing, I think is quite limited this time. So the trade tensions are coming at the wrong time for China, when they've already expended many of their bullets in terms of series of three housing stimuli. I think that is coming at the wrong time. So with the current account coming under pressure, I don't think China can stimulate the economy, and therefore weaker growth, surely, weaker currency very likely, but not a crisis. But then nothing's priced for a crisis in China.
Yeah, so Richard, we've got some economic tensions, but political tensions too, because interestingly, Donald Trump has decided he is not going to turn up at APEC. Instead, he's sending Mike Pence, who's recently made some pretty incendiary comments about China. And then we've got Japan's leader, Shinzo Abe, turning up in Darwin at the end of the week. Now, I don't think that the Japanese have been there since the Second World War. So how do you see Australia's positioning here?
Well, it's very interesting about Donald Trump. The big narrative for many years about, the large confabs in Asia, APEC, the East Asian Summit, has always been to America, just turn up. But in the case of Mr. Trump, I think people are saying, actually, no, don't turn up, Mr. Trump. So many people, I think, pretty happy Mr. Pence is coming. Now, Mr. Pence does embody the new, tougher US line, but I think he's also a professional politician, and he'll handle himself, well in that respect.
But does it give an opportunity for Xi Jinping to actually have more of an impact, I suppose?
Yes, absolutely. I mean, Xi will dominate APEC over the US. There's no doubt about that. And the Chinese usually do at regional fora in Asia. But, Japan is a real competitor to China in Asia. It's a competitor diplomatically. It's a competitor economically. Most importantly, it's a competitor diplomatically. I mean, Japan has sort of followed China around on the Belt and Road and sort of tried to match them. And Mr. Abe, of course, is the one who's the inspiration for the Quad. He's the inspiration for the Indo-Pacific, or the free and open
quadrilateral deal.
The quadrilateral, which has India, Australia, the US and Japan. And of course he will be coming to Darwin, and I would say the first Japanese leader. We're lucky he's the first, because it was only the Japanese Air Force that made it in 1942 or 1943. So that's a symbolic meeting. I think Scott Morrison will be there, perhaps Mike Pence as well, and so that's going to be interesting at the same time.
Richard McGregor, Bhanu Baweja, thank you very much.
Thank you. Thank you.
Well, switching to banks now, and the next, no doubt, gruelling session of the Royal Commission starts in a few days' time, where, among others, each of the big four bank leaders will be in the hot seat. The results season, though, revealed just how much pressure these banks are under in their ordinary business, with the softer housing market, the prudential rules biting, and, of course, the provisioning for sorting out out-of-pocket customers, so-called remediation. Top bank analyst Brian Johnson from CLSA came in to give us his insights on the banks ahead of his big annual report on the sector. Brian Johnson, really good to have you in here, and I know you're in the middle of writing one of those epic Brian Johnson reports after earnings season. But how did you see the big four shape up after the?
I thought it was a pretty ordinary reporting season. We see asset growth slowing, we see NIMs contracting, we saw financial markets earnings normalising. We probably saw an inability to take out operating costs because the software amortisation charges are rising. The thing that saved us was really, really low loan loss charges. That can't continue forever.
That can't continue.
So the highlight was that in a low credit growth world, the capital positions look really, really strong, which means the dividends are probably sustainable. It's just that nothing is going to grow particularly fast from this point of view. So net, I'd find it was probably slightly disappointing and saved once again by really low loan loss charges.
Well, there are a couple of things, really interesting things you've said there, but just before I forget, a couple of these CEOs, and Shane Elliott in particular, was saying going forward, credit growth is really going to slow. I think that's the view of all the banks. There's even some suggestion on the front of the fin today that there'll be a credit squeeze, and that there'll be a lot more prescription that the banks will use. Do you think the banks are trying to pressure the government?
I think that's exactly right. I think that's self-serving rhetoric from the banks trying to dampen down on anything that comes out of the Banking Royal Commission. But the reality is that what we're talking about taking out the imprudent, ill-disciplined lending that banks have done historically. Sensible lending can still be done. I don't really subscribe to this credit rationing argument. But that
it's not going to dry up.
No, it's not. But that said, credit growth will slow. And the reason is that when we have a look at it, personal credit, we can see debit cards supplanting credit. When we have a look at business lending, companies have been so concerned about what could happen going forward that they've been winding back on their capex, hoarding their money in deposits with a bank account so they don't go bust because they've actually got net cash but they're not borrowing. And then when we come to housing, most housing credit growth is generated from basically the historic appreciation in house prices. House price growth slows, then housing growth fades. So any way you cut it, credit growth is going to fade.
All right. The Royal Commission itself, we've seen the damage it's done in terms of the provisioning that's gone on and the remediation costs in particular for customers. Do you see a lot more surprises because between now and, say, February?
Well, the one thing about basically Royal Commissions, they've got these broad investigative powers that can investigate anything that they basically find during the investigation. But when we actually have a look at what's happened thus far, I think that what we should do is we should view it in the context of the bank executive remuneration, the new BEAR framework. And what happens is any time a bank basically has one of these events happen, then the executives of basically their remuneration will fall. And so
Westpac recently just cut their by 30%, I think.
So there's an incentive to do it all once rather than have it keep on happening. Now, that being said, not all the banks have dealt with everything. So, for example, Westpac have still got to deal with the aligned dealer groups. But certainly, this idea that this gets to be a bigger number next year than this year, I don't actually subscribe to that view. I think across the sector, the incentive there was to bring as much of it out as they could.
And NAB with its ASIC business?
Well, when we actually go through, we should put any of these fines and remediation charges within the context of the size of the banks. And because all the malfeasance was done under the previous legislative environment, the chance of really, really big fines, I think, is negligible. So, and the numbers all sound very dramatic, but when you think that they're probably more one-off, they don't happen every year going forward. They're relatively immaterial compared to the size of the banks.
Brian, you mentioned at the beginning that you thought the banks were in a position to continue to pay dividends, that the growth wasn't there, but they're set up to pay dividends. I mean, a lot of people wonder whether that's actually right, whether they will be able to continue to pay these great dividends.
Well, the thing is that APRA have set the magic numbers that you need to get your core equity Tier 1 ratio to 10.5%.
Well, they've just announced further.
Yeah, well, by virtue of divestments, ANZ and Commonwealth Bank are way north of that number, so they don't need to cut. National Australia Bank have enunciated that they've got a clear pathway to get to 10.5%. I don't think they need to cut. And Westpac's capital position is already above the 10.5%. And it really comes down to, if we go back to the Financial Systems Inquiry, it spoke about banks being unquestionably strong and in the top quartile of banks nationally. Internationally, the fact is that they're actually not. So the whole idea of unquestionably strong top quartile, that seems to have been not actually have happened. The latest data from S&P would put them probably median in the world, but APRA gets to set the rules, not Brian Johnson. So in that sense, I think they can probably hold the dividends. They don't grow, but they can hold them.
And how are banks, these big four banks in particular, priced at the moment? I mean, where do we see them in the index?
Well, if we were to break the market up into three components, resources, banks and non-bank industrials, then what would actually happen is the banks are trading at about 82% multiple of the market overall, and that's in line with the long-term average, notwithstanding the fact that we can see asset growth slowing, NIMs fading, financial markets, not much cost out, and at some point loan losses go up. So the forward EPS growth outlook is nothing amazing, and yet they're trading in line with the long-run average. That's not particularly compelling.
No.
So at best, that's fair value. But what makes them offer relative value is that the non-bank industrials are trading at crazy high relative PEs, and it's the risk in the rest of the market that means perhaps the banks stack up. But because I can't get my head around them actually justifying absolute value, and because it looks to me as though the next election means Labor is going to win, I would actually flag to you their policies don't look friendly for banks, so I'd be still inclined to be underweight.
Right. There's one bank just beyond the four that's looking more interesting, Macquarie Bank.
Yeah, when you have a look at Macquarie are riddled with excess sources of growth. And the other thing is...
Riddled with growth.
Riddled with growth. And a lot of the businesses they're in. And what you can see is they also have very, very conservative accounting. So whereas their peers would recognise a performance fee they'd accrue for them every year, Macquarie don't recognise them till the end of the life of the fund. Macquarie, their equity investments, they tend to carry those very conservatively. But the really exciting thing is, forget whether you believe in climate change, the fact is that renewable energy is coming. And the opportunity to grow into that space in their infrastructure business is gigantic. Now, just to give you some numbers to wrap it together, there's been estimates that by 2030 there'll be $4 trillion globally invested in new renewable energy infrastructure. If you gear that 50%, that's $2 trillion. Macquarie's existing infrastructure business has got about $100 billion of equity under management, and that business has got a competitive advantage in this particular space because they bought Green Investment Bank in the UK. This could massively swell the size of their business. So on Macquarie, it's a lot more than a vanilla, volatile investment bank. This is the world's biggest infrastructure fund manager, and that's why I think it's incredibly cheap.
Really interesting. Brian Johnson, thank you so much for your views.
Thank you.
After the break, the biggest shopping event in the world, Alibaba's Singles Day, recapping the weekend's big bonanza with Alibaba Australia's Managing Director, Maggie Zhou from...
You're watching Ticky on Your Money. Now, back to Ticky.
Welcome back. Well, Alibaba's Singles Day, the biggest shopping day of the year, has smashed its own records yet again. Alibaba has logged over $30 billion in sales for its annual Singles Day extravaganza. On the ground in China this weekend, our very own lucky chief business reporter, Leo Shanahan, spoke with Alibaba's Managing Director of Australia and New Zealand, Maggie Zhou, on the success of the event and what it means for Australian customers.
Maggie, Zhou, thanks so much for joining us.
Thank you. Thank you for coming.
Thank you. Now, what can we expect from the Alibaba's 11/11 festival this year?
This year for Australian, I see. This year, actually, it's a very exciting moment for Alibaba. This the 10 years anniversary for 11/11 shopping festival. And Australian still, you can see the very good growth for 11/11 this year. We have already have the pre-sale, the period for consumer, and we can see the sales pre-sale for Australian already year on year is about 150%. And those categories were very popular in China. This year also you can see very strong in China consumer market. Those categories about this vitamin products and mother and baby and natural skin care. And this year also we can see some new category is growing. It's like the pet food. And pet food from Australian is really welcome in China market. Yeah, and many, Chinese family, they love pets. It's as the same as they love their children. Yeah.
Now, on those products, where does Australia rate now in terms of countries that Alibaba consumers are buying from? I think it was about 4th last year, wasn't it?
It's 3rd last year. Yeah. But we. It had just the beginning, for tonight. But you can see those growths. Yeah, we are expecting for that. Australia has a very good performance this year as well.
Yeah. Now, what companies? We know those kind of those dairy companies, those vitamin companies that do particularly well on this weekend, and generally for Alibaba. But are there any other companies, new companies that you mentioned? That you can mention that are doing particularly well this year? Australian company?
Australian company, yeah, Swiss, Blackmores, and Bio Islands, they still do very well this year. And Jessica Suitcase also, they have just incubating some new brands. They also doing very well. Yeah, and the pet food is also quite well. This like the Billy Morgan. I forgot the name. Yeah, so that's also new hero for this year. Yeah.
Now, there's been some concerns in Australia lately about some changes to Chinese laws in importing and labelling. Do you think that this will curtail the strength of Australian imports to China?
Well, I don't think so. Actually, that's all the positive info, the message with coming all these years, all these days. Yeah, for this CIIE Expo, and President Xi Jinping also announced update his plan. That is in the next 15 years, the import for the products is about the 30 trillion US dollar, and also 10 trillion for the services. And CII is really real support for President Xi Jinping's promise for the import. Yeah, and then the other Alibaba, that is we have the announced 200 billion US dollar in the next 5 years. Yeah, and for the regulatory, I think it's if the direction is positive, the direction is following the direction. So no worries for that.
Yeah, there's been a lot of concerns as well in Australian business generally about trade war between China and the United States. Jack Ma, I believe, is on the record lately saying that trade wars are dumb. Do you agree? And what is Alibaba's concerns around this kind of issue?
Well, I think that's the good relationship between two countries is really fundamental for the trade between two countries. And I see that very confident. And in the past week, Australian foreign minister and met Chinese foreign minister, and they have a very good discussion. So that's a really good improvement. And we see that it's also will make it better better for our business environment.
I'm interested, your expansion, I see so many people in China now using like WePay. It's hard for Australian consumers to use these kind of things. They're more cautious about these kind of pay apps. Is there any kind of plans for expansion into Australia to use these kind of these pay apps?
Actually, we have already enabled in Australian markets to enable those retailers can use Alipay to access Chinese tourists. And we actually started an initiative in Melbourne. It's like called Buskers program. So today more and more cashless, the society cashless, and made those artists feel very concerned about maybe in the future artist industry will disappear. But actually we work with our partners to enable those ambassadors can use their terminal, our partners' terminal, with the scan QR code for Chinese tourists, and then just to pay the tips for those baskets. But also we enable our partners to enable the baskets to let the Australian citizens can also use Visa and Master and tap and go. Yeah, so those kind of things, I think it's not just a worry, actually it's a convenience for Australian retailers, but also we can have the opportunity to have the Australian those citizens can also get the benefit for that. Yeah.
From a business perspective, some people have mentioned that there is some concern about Alibaba's global structure. That is, that theoretically it could still be made, its share structure could still be made non-viable.
We actually also always operated it's healthy. Yeah, our philosophy is always just for and all the design for benefit for our customer, and the shareholder is that we put that as customer first and probably second, the shareholder the third. Yeah, so shareholder actually is always that. We see is that the result. We don't put that shareholder for first, and also we will lost your direction for the operation.
And new Australian companies doing deals recently. Freedom Foods did a deal with Alibaba, and more. Is there any other Australian companies that you foresee that are in the negotiations for new deals?
Some. And Australian brands, they want to have the ambitions to China market, and they want to step into China market, and they want to see the broader opportunities. But sorry for before that we cannot release for that. But actually we see that.
I'm just trying.
Yeah, we can see the confidence and that is there from those merchants to commitment to Chinese market.
Okay.
Yeah.
Well, Maggie, thanks so much for joining us.
No worries. Thank you so much. And enjoy your Double 11 in Shanghai.
Thank you.
Thank you.
Chief reporter Leo Shanahan talking to Maggie Zhou from Alibaba in Shanghai there. Interesting to see her rank, first of all, the customers, and then the employees, and then the shareholders, actually spelling it out there. After the break, is the UK government on the verge of total surrender in its Brexit talks? With David McCready, CEO of the Australian British Chamber of Commerce, next.
This is Ticky on Your Money, covering the big business stories.
Welcome back. Well, British Prime Minister Theresa May is entering another week battling to keep her Brexit plan alive. The main fight is on whether the guarantees the Prime Minister is offering to avoid checks at the border with Ireland after Britain leaves the European Union in March will bind Britain to the bloc's rules indefinitely. Opposition from all sides is mounting, casting doubt over whether her plans will actually get through Parliament, where her Conservative Party is divided and lacks a majority. Well, pro-EU lawmakers say the plan represents the worst of all worlds, while Brexit backers want a clean break with the EU so Britain can strike new trade deals. Then you've got the Northern Irish lawmakers who fear the province will end up being treated differently to Britain. Well, for more on the Brexit situation in the UK, I'm pleased to welcome David McCready, Chief Executive of the Australian-British Chamber of Commerce, to the desk. Well, David, I mean, you've obviously got your own interest from the Chamber's point of view in the outcome here. But for those that don't watch Brexit every single day, what is the British Prime Minister trying to get? What sort of deal has she got on the table?
So it goes back to the Chequers Agreement from earlier in the year, which after which she lost a couple of senior cabinet ministers. David Davis, who'd been leading this area of work for the government, and then also Boris Johnson, who was Foreign Secretary.
They were both pro-Brexit, strong Brexit.
Both very much both strong pro-Brexiteers. So that's the model thereabouts, although there's been some, obviously, negotiation between the government.
But that Chequers model, was that staying in the customs union?
So the idea is that we need to sort of go back a step to figure out how all this fits together. So if there is a deal of any sort, one of the things that has been agreed, but nothing's agreed unless everything's agreed.
Yes.
So what's been agreed, should there be a deal, is there will be a transition period between the 29th of March next year, when Brexit formally occurs, to the end of December 2020. And during that period, should there be a deal, the EU and the UK will undergo a free trade negotiation and hopefully wind up with a deal post that, which makes this whole conversation actually irrelevant, because whatever they negotiate in that will supersede whatever is negotiated now. But because there isn't an agreement as yet, they're worried about what happens in Ireland, because clearly the troubles, we all are fairly aware of the issues that Northern Ireland had for quite some time.
Well, Europe knows that this is Britain's Achilles heel.
Well, it is, and the agreement is that part of the Good Friday Agreement is that there is no hard border between Northern Ireland and the rest of the Republic of Ireland. And I think broadly all sides are very happy with that arrangement.
Yes.
I understand that the trade that actually occurs across that is about 0.2% of the UK's trade, so it's not a huge amount.
No.
But the problem is the EU sees this as this might be some backdoor way that the UK might keep trading illegally, from their point of view, through the rest of the EU.
Yeah, so this has become a massive deal now, and we've got this, you know, situation where Theresa May might be putting up a deal which actually now it's suggesting that we might end up with the European Court of Justice deciding whether we can get, or the Brits could get out of this deal or not. Now, surely that puts us back into the situation, worse than the situation, if we hadn't actually done a Brexit at all.
Possibly. And well, yes, in the essence that if the UK winds up in a customs union and in the single market, there will be benefits in terms of continued trade with the EU.
Well, there'll be no change on that front.
So there'll be no change on that front.
But we can't change anything in the future.
But on the other hand,
speaking as a dual citizen here, sorry.
Well, that's right. But on the other hand, you've got the issue that Liam Fox has been around the world, including here to Australia, saying we're looking forward to doing a free trade agreement with any and all countries that are interested, and particularly Australia, New Zealand and the US that they've outlined as their first targets.
Now, that would be possible under Theresa May's deal?
Not in the short term. Well, it depends on, again, if the transition period is going to end, it will depend on what would exist after that transition period. It may just purely delay the hard exit, if you like, which would happen on the 29th of March next year, just to the end of December.
Because I was earlier under the impression, I think a lot of people were, was that by March we would have decided what model, broadly, we were going to go out on. In broad terms. Now, clearly... But
all those models that you're talking about, like the Norway model or the Canada +++, or Norway
Chequers.
For now, or most of... Well, not Chequers. The other ones are all models about what they'd like to see in the future. And the EU has been absolutely steadfast in saying, we're not prepared to talk about the future until we understand what the divorce looks like. And because they've managed to maintain that line, and the UK as yet hasn't managed to move them on to the future trading arrangements, this sticking point of the Irish border continues to be a sticking point, which if you were to, just for a moment, put it aside and say, let's start talking about the future and talking about how closely UK regulations would continue to mirror or be easily managed across UK versus EU regulations, standards, etc. You could probably move past this fairly quickly.
But we've now got a situation where Zhou Johnson, Boris Johnson's brother, who was also a minor minister but a Remainer, unlike Boris Johnson, has actually resigned because he certainly believes that the position his Prime Minister has put him into, or Britain into, is actually more restrictive. In other words, there's no upside, only downside.
Well, the challenge is if the UK accepts anything which leaves it in the single market and the customs union, then all deals about a free trade agreement with places like Australia, which obviously we're very interested in, are off the table, and it would have to be negotiated back through Brussels, which actually isn't too much of an issue potentially for Australia in terms of the fact that we're already negotiating a free trade agreement with the EU. However, we strongly believe that that's very important, and Australia should definitely prosecute that case. However, we think that the UK on its own will do a much better deal, a much more comprehensive deal, and a better deal for a number of our industries, not least of which being agriculture, which we know the EU particularly will be harder on than the UK potentially. So from an Australian perspective, it doesn't sound great if we're having to go back through Brussels, although at the same time, we'll have to wait and see what the Brussels team come up with the Australian team in terms of Australian EU.
And how many countries are going to have to agree to that all at the same time?
Well, there are 27 countries in the EU minus the UK, so 28.
Yes,
so 20, the remaining 27 are involved in that negotiation. But similarly, at the moment, because the UK is on its way out, a Norway-type deal or a Canada-type deal doesn't give it a seat at the table for those arrangements. But on the other hand, if it's a Canada-style deal, then a broader free trade agreement with Australia or the US or Canada even, they may get some better deals out of that. So
it's a really dangerous place, though, right at this moment. Do you think anything is actually going to happen this week?
Well, it's been really interesting because I think the pendulum is swinging hard and fast from one side to the other. I mean, you only have to go back in less than a week ago. The European side was saying we might be 4, 5, 6, maybe 7 days away from an agreement.
Yes.
And now that seems a lot further away. So
ebbs and flows.
I think there'll be a bit of time needed and a deep breath by all.
All right. David McCready, thank you so much for joining us. It's great to talk.
Pleasure.
Well, after the break, talking fintech and future capital with co-founder of Square Peg Capital, Paul Bassett.
Now, back to Ticky.
Welcome back. Well, it's been almost 20 years since the two Bassett brothers, Paul and Andrew, founded Seek, the employment disruptor, which had such an impact on the jobs market. In 2011, Paul Bassett moved on to start his own venture capital business, Square Peg, which has built its own reputation as one of the clever VC outfits, particularly in the fintech space. Well, I spoke to Paul Bassett on the UBS Australasia Conference sidelines today. Paul Bassett, super to find you here. Tell me about your most exciting investment at the moment.
Oh, it'd be hard to separate one, but we're doing a bunch of things in Australia, Southeast Asia, Israel. Fintech is a pretty big area of focus for us. We've made 3 or 4 fintech investments in the last 12 to 18 months. A number of marketplace businesses, enterprise software. So there's a whole range of companies we're very excited about.
Why do you see fintech as a fertile ground? Is it the fact that we've got open banking coming, or is it also the Royal Commission?
It's a whole range of factors occurring at once. We've got very, very large profit pools. In Australia in particular, you have returns on equity that are very high by global standards. You have technology enabling disruption. You have a lot of talent, particularly again in Australia where we have some really great entrepreneurial talent, but who also have strong pedigree in financial services. And the Royal Commission, I guess, is another factor at play. But there's a whole range of factors at once that's a real catalyst for significant disruption in financial services.
So what sort of companies are you involved with?
Yeah, in financial services, there's companies like Athena that are going to be launching early next year, disrupting the mortgage market in Australia. Airwallex, disrupting global payments market, foreign exchange. low value, high volume payments, particularly operating out of the Chinese market. We've got Prosper in small business lending. In Indonesia, we've got Kredivo, or Finexcel, which is the parent company, which is consumer loans. So a whole range of companies in financial services.
And you're not that enthusiastic about neobanks. Now, why is that?
The question we've got on neobanks is that, you know, the benefit that they're going to have is they're going to have the ADI, that they're going to be effectively a bank, and they're going to be licensed as a bank, which allows them to take retail deposits. And in theory, that's an advantage. But the disadvantages of being a deposit-taking institution and being regulated, particularly in terms of the requirements of capital. And some of these neobanks are going to have to raise many, many hundreds of millions of dollars over the next few years.
Whereas Athena's not an ADI.
Athena's not an ADI, and it's going to rely on wholesale funding rather than deposits from individuals. And we think that's a much better model. They're going to require them to raise much less capital, much more nimble, much more flexible. So our view is broadly that the benefits of being a deposit-taking institution are actually outweighed by the costs.
But more exposed, obviously, to rates?
Yeah, look, to some extent. And one of the things that Athena is doing that we think is really interesting is a really interesting funding model that's worked very well in the Netherlands, where not only they can be relying on warehouse funding and residential mortgage-backed securities, but they're also going to be looking for funding from the superannuation funds to provide them with appropriate risk return in terms of cost, but also a stickier source of funding than the traditional residential mortgage-backed securities.
So this is super money going directly in as debt or equity?
Going in as debt. And that we think is a really attractive and exciting part of the funding mix.
Is this a new space?
It's a pretty new space. So in Australia, we haven't previously seen. Obviously, super funds participate like a lot of other investors in residential mortgage-backed securities market, but this particular model of them directly funding the loan book via debt funding, we think is very attractive.
Yeah, it sort of has similarities to what Anthony Pratt, Gina Reinhardt was trying to do in terms of the direct lending to business.
There's certainly some similarities and overlap. I think that the core thesis here is that you have very, very large pools of capital from the superannuation funds, and that can go to really, really productive purposes that are going to be of an enormous benefit to the economy.
Now, looking at some of your other investments, in particular Prosper, what do you think the chances are of challenges ahead with businesses like Afterpay? Prosper might get caught up in that in terms of the alternative, I think, Labour-led inquiry that there might be outside the Royal Commission.
Yeah, look, the reality is Prosper is lending money to small businesses who, in a lot of cases, aren't otherwise able to access funding. They have an incredibly high repeat rate from their customers. They have a net promoter score in the 70s, which is as good as Apple. It's absolutely global best class. When you compare that to our banks, most of which have a net promoter score which is negative, it really gives you a sense of the level of satisfaction of their customers, how well they're looking after their customers, and the problem they're solving, which is a lot of these customers can't access funding from the big banks, and that problem is even exacerbated.
But the rates are high, 40% or whatever.
The rates are on the higher end. They're a little bit lower than that. They're coming down as their cost of funding comes down. They'll be passing those benefits onto their customers. So the rates that businesses pay will continue to go down.
And business is well aware of what they're getting themselves into. I mean, that's the important thing.
Well, and it's not so much well aware of what they're getting into. They are absolutely borrowing these amounts to fund growth, whether it's to purchase stock or open a new store or fund a fit out, and they're meeting an incredibly important market need, and their customers are unbelievably happy with the service that Prosper's providing them with.
Another sort of interesting space, PEXA, which is being haggled over at the moment. Do you think that's the right thing that a bank like Commonwealth Bank should be doing, picking up PEXA?
Look, in terms of who should own companies like PEXA, I think I'll leave that to others to form a view on. But the broad principle that we're moving from a very traditional, fairly archaic method of land title settlement in Australia to a digital model where everything's digital, where you have a much simpler process in terms of settlement, in terms of records, etc. That's certainly a good thing, not a bad thing. And so that innovation, which actually came out of COAG, I think has delivered real benefits to the country.
How do you think we rate example, compared to other VC hubs, I suppose, like the West Coast and indeed Israel?
I think what you'd say is the last 5 years has been a really, really good period for innovation in Australia. We're seeing more venture money be raised and a number of funds emerge. We're seeing more great entrepreneurs build fantastic businesses, increasingly focusing on solving large global problems. So there's a really great, very exciting glass half full perspective. We are clearly some way behind the best ecosystems in the world, such as the West Coast, such as Israel, and they're very much a benchmark and something that, you know, Australia needs to aspire to, that we continue to become a more and more innovative country where we have more and more young businesses that emerge that are disrupting large global markets. We invest in Israel and Southeast Asia as well as Australia at Square Peg, so we have...
But is that what it's going to take? More ideas, more businesses?
It's going to take more capital. In particular, it's going to take more fantastic entrepreneurs. We want more and more of our best and brightest pursuing entrepreneurial careers, pursuing disruptive business models. Typically, a lot of our best and brightest go into financial services, and we're very talented in that area. Love to see more of our best people form great entrepreneurial ventures like the Atlassians, like the Invatos, the Campaign Monitors, the realestate.com.au's. So we've had some great companies emerge in Australia in the last 15, 20 years. We look at our portfolio and the portfolio of other venture capital funds in Australia, and we think there's some very, very exciting companies emerging, companies that you've mentioned like Prosper, Airwallex, Athena, Canva, Safety Culture, a whole lot of businesses emerging in this country that we think are really, really exciting businesses. And so it's a great story, but we've got a long way to go.
Paul Bassett, great to talk to you. Thanks very much.
Thanks, Ticky. Appreciate it.
And that's all for the show tonight. Tomorrow night, Woodside Petroleum CEO Peter Coleman. See you tomorrow night at 6 p.m. on free-to-air channel 95, 5 p.m. actually, or tonight, catch up at 8 p.m. on channel 604 on Foxtel. Thanks for your company.